If you're looking to buy a franchise, the first question that stops most people is, how do I pay for this? I came from the funding side of franchising before I helped people buy their first franchise. So let me walk you through the 5 main ways people fund their first business. By the end of the video, you'll know which ones fit your situation before we ever get on a call. Let me start with the one that most people have heard of, the SBA loan. The credit profile that candidates need to have can really vary. Truthfully, anything above a 720 is ideal, especially if you don't have any recent foreclosures, bankruptcies, or anything like that. You're going to be in a strong position to secure funding. If you are below a 720, it's going to be more difficult, but not impossible. For the most part, if you have a 680 or higher credit score, there are going to be options potentially for an SBA loan too, depending on what factors were in the past. When looking at a down payment for a business, the SBA typically requires a minimum of 20%. In some cases, it can be around 30%. Other times, I have seen as low as 10%, though it's not common. Typically, it's going to be in that 20 to 30% range. The SBA itself actually has a registry where franchises can go through a process to get approved through that registry. It means they have gone through the hoops in order to qualify for SBA lending, but it doesn't necessarily mean it's a better or worse franchise. Let's talk about SBA loans. Typically, people think of using an SBA loan to fund their business. That is very common, and I totally get that. They are a mess to get through. They rarely go well, and they can be like some of the most frustrating processes I've had clients go through. That doesn't mean they're bad. If you remember the first time you bought a home, the paperwork and everything necessary to get a home loan was also exhausting. There was also a lot to it. The key here is that it can be worth it to go through the hoops to get an SBA loan, but there are going to be a lot of hoops from your end as well. Number 2 on the menu, ROBS. That stands for Rollover for Business Startup. The majority of people I work with are not familiar with this opportunity. ROBS basically allows you to invest a portion of your retirement funds into your own business without paying taxes or penalties now. The way it works is pretty straightforward. Initially, a corporation is created. It has to be a C corporation. It cannot be an S corp or an LLC. After that C corp is created, a 401k plan is attached to that corporation. What that means is that you now have your own business and it has a 401k plan as well. You then can take your existing retirement assets, roll them over from your current 401k, IRA into your new 401k, but instead of investing into stocks, bonds, mutual funds, etc., your corporation actually issues private stock. Your 401k can purchase that stock. Money is then transferred from your 401k to the corporation, and you can now spend it on your business for any business purposes. The value of your funds, though, are going to be now tied to the value of your business. So as an example, if you invested 100 grand into a business, and let's say for sake of this example, that business doubled in value. When you sell it, that 200,000 will go back into retirement and still be tax deferred. Rollovers for business startups, they start making sense typically somewhere around $50,000 to $100,000, depending on your state and the tax consequences. The big trade-off here is that you are pigeonholed into having to set up a C Corp rather than the flexibility you'd have of an S Corp or an LLC. It also does create a 401k plan, so there are going to be ongoing administrative items for that 401k. It's not right for everyone, but I can say it's also often used as the down payment so people can secure an SBA loan or fund fully in cash. So when it comes to the exit strategy, and just to be clear, I'm not giving financial advice. This is just what I've seen it work with other people. You can either sell your business as a stock sale or have it as stock purchase or an asset. So if it's an asset purchase or asset sale, money's going to go from the buyer to the corporation specifically. It then has to be paid out as a dividend in order for you to get those funds. But there's also a stock purchase, and with a stock purchase, basically money transfers directly from the buyer to the seller to purchase the stock, and so you aren't subject to corporate taxes. So it's a much more effective way to do it. But candidly, I've been out of the financing game for at least 5 years, so I'm not the right person to talk about it today. All right. Quick thing before we get to the last 3. If you'd like to discuss your specific situation with me, the link in the description lets you book a complimentary 30-minute call. I'm not going to pitch you anything. We'll go through which of these 5 plays make sense for your credit and what cash you have to put in. The franchise companies pay my fee on the back end, so the call does not cost you anything. Let me keep going. Now, here's the part most candidates miss. These next three are how people actually close the gap when SBA and ROBS alone don't cover the whole investment. Third one, home equity. That can be a HELOC or a cash out refi. A cash out refinance, it's pretty straightforward. Let's say your house is $500,000, you got about $250,000 of equity in it. So when you refinance it, your loan's gonna be now at $400,000 at today's rates, but you're gonna pull out 150 grand in cash for that. Home equity line of credit is more like using your house as a credit card. So home equity lines are very attractive rates. They're typically lower than SBA. They're often fixed. They're often 15, 20-year terms, so longer repayment terms, and just more flexible in general because you can get a home equity line of credit for that same house, but instead of pulling out the cash, you're getting a line of credit for $150,000, whether or not you use it all. So if you only end up needing 10,000 of it, 20,000 of it, great, you're only paying back 10,000, 20,000 worth of it, rather than getting a lump sum check for 150. And if it's not clear, people tend to use home equity lines of credit more often than cash out refinances. You know, a while back, there was this person I was working with. They clearly were a better fit for a home equity loan over an SBA loan. Their house was paid off. They got an SBA loan. There's going to be a lien on the house anyways. So in this case, it made a lot more sense for him to do a home equity line, borrow money against his own house, and not have to go through all the hoops that it takes for an SBA loan. Okay, then we have SBLOC, Securities-Backed Line of Credit. An SBLOC is a lot like a home equity line of credit, but instead of doing a line of credit against your house, you're getting a line of credit secured by a brokerage account. So if you have over $100,000 invested in stocks, bonds, mutual funds outside of retirement, you can get a line of credit often for up to 80 to 90% of that amount. What that means is you don't have to sell off your stocks. They continue to grow in the market. And that line of credit is one of the most attractive rates out there. You're looking at typically the LIBOR rate plus a little. I want to be cautious because I don't know what the rates are today, but they are significantly lower than both the SBA loan and often a home equity line. Even when they're not, another benefit is that this is an interest-only line of credit. So the payments are very low and you can start paying the principal off whenever you're ready. So the right candidate for an SBLOC typically has at least $100,000 in a brokerage account. That's number one. Number two is they're also typically more conservatively invested. This doesn't mean, to be clear, that they can't have some individual stocks inside of that, but typically the more you want to borrow, the more they want a stable portfolio to borrow against. So if you're invested in the S&P 500, if you're invested in ETFs that are, growing, those are all going to be a fine fit. The reason somebody would borrow against a portfolio rather than selling the stock is you're subject to capital gains taxes if you sell the stock. If you borrow against it, then you don't pay taxes, and actually you now have a potential write-off for the business because of the interest being paid on that loan. And to round it out, the unsecured term loan stack. So there are two types of unsecured lending that's interesting. There are term loans. These ones are typically a fixed interest rate. It is going to be on the higher side, but it's a fixed payment, a fixed term, and it can be 5 years, 10 years, or even longer. The second one is unsecured lines of credit. I am hesitant on this option because these are often very high interest rates. They can also just be liquidating credit cards, so the risk is very high. So with unsecured, I wouldn't say there's an upper limit per se that it makes sense, but you're not going to be able to fund $1 million with this. So usually I see people get between $100,000 to $200,000 that they qualify for, but the downside to this is these are higher interest rates. For anyone who's been thinking about owning a franchise and the funding question is what's been stopping you, click the link in the description. Book a free 30-minute call. We'll go through your numbers together and figure out a realistic stack for your situation. There's no cost, no obligation. We'll see you on the call.